to the trader who has the ability to buy here and sell there, sell 10 million ounces at a $13 profit, you just made $130 million. Have a nice day. You got the whole world is looking at silver as something very important, and the price is set in one place, New York. And if you're going to screw with the price in New York, you're going to get called out maybe.
You think this is going to Switzerland. What does this export number signal to you?
We're blowing through munitions, and that the rare earths are critical to, the heavy metals are critical to the advanced weapon systems. And as we're burning through munitions at a pace that raises questions about supply and replenishment and military staying power, Luke Roman talked about it today, that ships that are Chinese manifest, oil that was paid with yuan rather, are being allowed to go through the strait. And so oil is making it to China. China has made a big deal about settling a lot of things around their side of the hemisphere in gold. This would be potentially very bullish for gold. If countries like China, where we're dependent upon them to make these weapons, we need the rare earths, which we don't really have.
Focus on silver very quickly as we're running out of time here. An interesting statement coming from the Bank of International Settlements, the BIS. Yeah, which describes the massive drop that silver saw at the end of January as the largest silver sell-off in history. It argues that the sell-off wasn't purely fundamental, but it was amplified by leveraged ETFs and forced liquidations, which created a self-reinforcing cycle of selling. So it states this in its quarterly report on market developments, and I quote, "The abrupt price drop and the spike in precious metals volatility point to the role of retail flows and amplification of price moves due to forced sales by leveraged ETFs, trend-following investors, such as commodity trading advisors, CTAs, and margin dynamics." Of course, the BIS is referring to that sell-off that we saw in January. Silver dropped around 36% on January 30th, its biggest one-day wipeout in a while. I don't know if on record. And then it came after a quick gain of more than 50% in just a few weeks afterwards. So obviously, we knew as prices started to fall, funds were forced to unwind positions. The theory goes triggering more selling, more margin calls, even more downside pressure. Why do you think, firstly, that the BIS came out with a statement like that? I mean, what are your thoughts of the BIS's assessment, and what do you make of the fact that the BIS chose to comment on something like this in the first place?
Silver's record one-day plunge hides deeper structural stress the BIS quietly highlights. As Andy Schectman points out here, the 36% drop on January 30th wasn't just market panic. It was forced liquidations amplified by leveraged ETFs and trend-following investors, retail flows, margin calls, and self-reinforcing selling cycles created systemic volatility that mainstream headlines ignore. For investors, this means underlying liquidity risk remains acute despite quick rebounds of 50% in subsequent weeks. Next, Andy Schectman discusses how institutional behavior continues to shape silver's fragile price dynamics.
It's interesting you're taking that position, because that's just what I was thinking. I read that, and it's almost like they're taking the U.S. to task. Like, you can't do this crap out in the open like this. Because it's just ironic, I guess, that the circuit breakers didn't work when the price fell and got collapsed. Just like the overheating on Thanksgiving night of the servers that have triple redundancy, and of the 1,000 commodities traded on COMEX, it just happened to be the gold servers in the middle of the night for 11 hours, because everyone's trading at midnight on Thanksgiving night. And you know, when you put all of this together with the levered ETFs that was right in the period of rebalancing as well, some of these funds that needed to be rebalanced, and the increase in margin, put all of this together with the circuit breakers that were glitched. It's almost like they're saying, really, guys? Really? You can't do this stuff. That's kind of the way that I looked at it. The BIS is the most powerful bank on the planet.
So wait, you're saying the BIS is calling BS on the U.S.?
Yes, I do. Because I think this is a globalized product, that there's a race for it right now. And, you know, it's kind of like, if you're going to bend the rules like this, once again, comes back to trust.
COMEX glitches expose more than tech errors. They reveal systemic margin and leverage pressure. As Andy Schectman points out here, circuit breakers failed during critical trades, coinciding with rebalancing ETFs and higher margin demands, amplifying forced selling. The BIS critique subtly signals global oversight watching US market practices and trust erosion. Investors should recognize that infrastructure flaws can magnify volatility in ways headlines never cover. Next, Andy Schectman shows why regulatory oversight may finally be signaling limits to manipulative behavior.
Why do you think there are, if you go back even before that, when I first started talking with you 3-4 years ago, all of the deliveries or the repatriations from the Bank of England and the New York Fed, lack of trust. Why are we seeing deliveries and lots of that metal leaving the exchanges, which would render it very illiquid? If you have truckloads of 1,000-ounce bars that have left COMEX, you have a real hard time selling that stuff unless you don't trust who's holding it and the rules by which they're playing. It's a lack of trust to me, and it was very right in your face. Yeah, there were glitches, and yeah, we raised margins so high that everyone got strangled out, and yeah, we did it. What are you going to do about it? And at the same time, you're seeing wicked deliveries with all of these. So that's the important part to remember, is that in times of stress, price is not where the stress shows up first. It shows up in deliveries, like the deliveries we're seeing to Shanghai. There's stress there. In a normal market, that arbitrage would have ended a long time ago because the big traders would have bought here, sold in Hong Kong, which is a COMEX contract, an exchange for physical, and have it driven over by truck to the exchange in Shanghai.
Physical silver movements reveal risk far before price swings suggest it. As Andy Schectman points out here, massive deliveries out of COMEX and repatriations from major central banks show a market-facing liquidity constraints and trust gaps. Arbitrage that should settle in days is stretched into weeks due to structural and margin pressures hidden from mainstream attention. For portfolios, this means market stress can spike even when prices appear stable. Next, Andy Schectman unravels how these flows signal deeper global imbalances in silver.
That arbitrage would have been done in days, but it's now going on weeks and months. Why? Because they're choking on dollars. They're willing to pay a much higher price for it. Please give it to us. A $13 charge right now, it's about 13%. So that's somewhere in the neighborhood of about 13, 14 bucks. At the same time, there's the VAT tax that they are responsible for paying when it leaves the Shanghai market. They're willing to pay about a 25% premium, but to the trader who has the ability to buy here and sell there, you sell 10 million ounces at a $13 profit, you just made $130 million. Have a nice day. So that arbitrage is real. I just think that what you are seeing is the West's desperate attempt to suppress the real value of silver, which, by the way, the European Union classified critical mineral a year and a half ago. China in November said, we're the largest producer, second largest producer of silver in the world. Everything that we produce, we're keeping at home for domestic use.
Silver pricing masks a global supply squeeze driven by geopolitical strategy. As Andy Schectman points out here, arbitrage delays of weeks, $13 per ounce costs, and 25% premiums reveal the West's struggle to influence real silver value. EU classification of silver as critical and China retaining production underscores long-term scarcity ignored by headline prices. For investors, the risk is structural, not just headline volatility. Next, Andy Schectman talks about how these supply bottlenecks could reshape portfolio strategy on market dynamics.
We're going to mitigate supply or exports, they said in January, as coming back to kind of retaliate against the United States calling it critical. You got the whole world is looking at silver as something very important, and the price is set in one place, New York. And if you're going to screw with the price in New York, you're going to get called out maybe now when it's a different game than it was before. This is, this recognition by much of the world that silver was more important than the dollar price that it is supposed to be valued at. I think if I had to guess, that's why they said it in the manner that they did. It's unusual. I felt the same way when I read it.
So what do you think the ultimate goal here is then from the BIS, especially in the context of where the price of silver is currently set?
That you can't do this kind of stuff. You can't break the rules like this, where we had, two glitches on the upside. When it was moving up, they knock it down. They stop
So
trading
like
and
a
the price
shot across the
collapses.
bow. I mean, they don't have
Yes,
any. They don't
yes.
have any ability to enforce anything.
No, but it is a
There
shot
is no
across the
legal.
bow. It
There,
is. It's a shot across the bow.
Global pushback on silver pricing exposes risks investors rarely see. As Andy Schectman points out here, world powers recognize silver's strategic importance beyond the New York dollar benchmark, and attempts to suppress prices are increasingly visible. Two trading glitches on the upside illustrate enforcement limits and the fragile infrastructure underpinning markets. For portfolios, this signals caution as rule bending and global scrutiny collide, potentially creating volatility hidden from mainstream coverage. Next, Andy Schectman shows why these geopolitical tensions over silver can directly impact market trust and liquidity.
And even though the United States, as you once very intuitively and astutely mentioned to me, that, well, isn't the BIS a Western institution? It is, but it's not just the United States. All of Europe classified silver critical. And so did, in essence, China, more or less. And so when you have the world that is accumulating something and the price is set in your backyard and you control it, well, you're supposed to play by the same set of rules. And if you have the ability to mess with the rules like that, I think it aggravates the powers that be. And in doing so, they blew up the refining industry in this country. Maybe that has something to do with exports going to Switzerland. And my belief, it's just a belief, that it's not going to China to buy rare earths, it's going to Switzerland to be refined because we can't do it fast enough. Would be my guess. Not sure. And it would leave too much of a footprint here.
let me play devil's advocate, as I like to do. Could it not just be that the BIS is echoing back the narrative? Because it says the abrupt price drop, the spike in precious metals volatility point to the role of retail flows, amplification of price moves due to forced sales by leveraged ETFs, trend following investors such as commodity trading advisors and margin dynamics. I mean, that's sort of the narrative that we've been given. Oh, it's ETF, it's over leveraged. It's become a retail trend, as a lot of people were interested in silver as opposed to crypto recently. Could it not just be that the BIS is sort of echoing that same narrative to enforce the system?
I don't think so. Have you ever heard in the mainstream the word margin at all in all of this? That is what really was the catalyst. You keep raising margins, you squeeze everybody out. And, did you hear any of this stuff? No, all we heard is that silver was overbought. And it was 1980 and 2011 all over again.
Global accumulation of silver shows rules matter when the world is watching. As Andy Schectman points out here, Europe and China treat silver as critical, and US attempts to manipulate price through margin pressures clash with international norms. Over-leveraged ETFs and retail enthusiasm amplify volatility, yet mainstream media ignores systemic risks and margin-driven squeezes. Investors should note that infrastructure, rules, and trust are at stake, not just price levels. Next, Andy Schectman unravels why margin mechanics are the hidden catalyst behind silver's recent turbulence.
We didn't hear anything objective. We haven't heard anything even remotely objective coming out of the media as it pertains to precious metals. They haven't talked about all the deliveries, not even once. So I think the BIS is regurgitating some of that, yes. But if you are, see, the thing is, what differentiates you, and the way I read it, is that we've been talking about all this stuff. Joe and Jane Sixpack reading that they'd miss that totally. They wouldn't get that. But if you are aware of what's going on, anyone who's aware of the shenanigans we've seen on COMEX forever, you might say, because immediately when I read it, I'm like, yeah, they're taking them to the woodshed right here and saying, you got to knock that crap off. They're doing it in a manner that would kind of fly under the radar by most people's estimation.
But just very interesting that they choose to discuss this in the quarterly report, in the first place. Yeah,
these things don't happen coincidentally in a vacuum. There is a little bit of, come on, you guys, what are you doing?
Media silence on deliveries masks real stress in the precious metals markets. As Andy Schectman points out here, the BIS highlights operational shenanigans and forced corrections that casual investors would never see. COMEX irregularities and unnoticed deliveries show systemic pressures that conventional reporting ignores, leaving portfolios exposed to hidden risks. Understanding these operational cracks is critical for long-term strategy. Next, Andy Schectman discusses how these under-the-radar signals reveal deeper market enforcement and trust issues.
So you're saying that you think this is going to Switzerland. Well, what does this export number signal to you? Break that down in a little bit more detail. You mentioned earlier you think it's going to Switzerland for refining.
Yeah, because they're talking about gold doré, and gold doré is a crudely refined bar that wouldn't meet any standards, and it's not pure. So if the gold doré were going to Switzerland for refining, and the headline level, it would still show up as gold export, reducing the trade deficit. The trade data tells you that the gold moved, not why it moved. So whether it is doré for refining or bullion transfer or arbitrage or whatever the heck it is, it can all look the same or similar in the top line numbers. So my guess is the refining situation here in the United States, they're building refiners, they're building smelters. This is one of the things that the Trump administration wants to do. Those that are already here in the States, I don't know how quickly they would get this job done with all of the log jams that they've experienced. So
gold export numbers hide the real story of refining bottlenecks. As Andy Schectman points out here, much of the gold may be heading to Switzerland as gold d'or for processing. Yet headline trade data only reflects movement, not intent. US refining capacity struggles, compounded by logjams and slow infrastructure expansion, conceal true supply chain risks from investors. Recognizing the distinction between exports and final delivery is key for portfolio prudence. Next, Andy Schectman shows why refining delays could alter gold arbitrage and market stability globally.
my guess is, and this is just a guess, right? If it really isn't, and we are sending it to China because they don't want dollars for rare earths, well, that's a scary situation as far as I'm concerned, and that's one that would have far more ramifications than if we're sending this to Switzerland to kind of keep it cloak and dagger, so to speak.
Okay, 2 points there. Does the export data actually show us where the gold is going? I'm assuming it does not indicate the destination.
I don't believe it does. I do not believe it does. And if it does, otherwise they would know definitively we're sending it to China. I think there's a lot of assumption.
There's speculation that gold is being sent to China?
Yes. Yes, because the theory that I've read on various news sources is that China would demand only gold for things like rare earths, that they know that we need.
The assumed path of US gold exports exposes a hidden strategic vulnerability. As Andy Schectman points out here, the lack of transparent data leaves investors guessing whether shipments go to Switzerland for refining or China for critical rare earths, creating geopolitical and portfolio uncertainty. Market headlines obscure the stakes, but real implications for supply chains and hard asset security are significant. Speculation alone can drive volatility in gold pricing and risk assessment. Next, Andy Schectman shows why clarifying export destinations is crucial for understanding gold's macro leverage.
We're in a situation right now where we're blowing through munitions, and that the rare earths are critical to heavy metals are critical to the advanced weapon systems. And so as we're burning through munitions at a pace that raises questions about supply and replenishment and military staying power, well, that's normally not a normal position for a superpower. And the deeper implications, I think, would be if America is becoming dependent on geopolitical rivals like China for these critical minerals, then this isn't just a supply chain problem. This is an environment where, again, back to trust, where dollars buy less trust these days. We've talked about that a lot, and hard assets matter more. So to me, it's like, China has made a big deal about settling a lot of things around their side of the hemisphere in gold. And it would signal a real shift as far as I'm concerned. And this would be very, very potentially very bullish for gold, because if countries like China, where we're dependent upon them to make these weapons, we need the rare earths, which we don't really have.
Dependence on China for critical minerals exposes hidden vulnerabilities in US military and industrial strategy. As Andy Schectman points out here, rare earths essential for advanced weapons create systemic risk when supply relies on geopolitical rivals. Conventional investors rarely factor this into portfolio strategy, yet it could influence gold demand as trust in dollar-based reserves declines. Rising strategic competition signals a potential long-term bullish catalyst for gold. Next, Andy Schectman discusses how mineral dependencies can reshape risk assessment across markets and hard assets.
And certainly they refine almost 100% of the rare earths, and they don't want dollars. When you're talking critical imports paid for with gold or real assets instead of infinite paper, then the higher gold price stops being a threat and starts becoming a necessity. And that would go in line also with devaluing the dollar, debasing the dollar, and fall in line with Judy Shelton's theory. I don't know who's doing this, but if it is, that is what we are doing. That signals a lot of problems ahead for the dollar, and certainly good things ahead for gold.
All right, that's a lot to break down. So basically, you're saying that there is a conspiracy theory out there, to be clear, speculation that this gold that is leaving the United States is going to China to be used to purchase rare earths, critical minerals that are essential for the defense sector as munitions are being drained by the conflict in Iran.
Gold's strategic role is understated in mainstream narratives, masking dollar vulnerability. As Andy Schectman points out here, when critical imports are paid with gold rather than dollars, higher gold prices transition from speculative threat to operational necessity, hinting at systemic stress in US reserves. Investors often overlook geopolitical leverage embedded in precious metals flows. Recognizing the alignment with devaluation trends and Judy Shelton's theories provides a rare lens into future macro pressure points. Next, Andy Schectman unravels why gold's rising necessity signals hidden stress in global reserve systems.
It is the one speculation.
It is.
The other theory is that it's going to Switzerland for refining, which seems to be more likely, more credible. Let's start off with breaking down the going to China theory. There is some speculation while we're talking down this line that the US is trying to create a trading chip with the oil via Venezuela and Iran in order to say to China, okay, we now have control over this oil, assuming this all works out well, and we can barter now more for critical minerals, that it gives them a leg up in the negotiations when it comes to rare earths. That part of the action in Iran, and of course the action in Venezuela, is controlling the cheap discounted oil that that China has been receiving from Iran and Venezuela, and it gives the United States an added bargaining chip in the conversation there. And it also makes sense in the context that President Trump is now postponing his meeting with China's President Xi for about a month now, pushing that out until this conflict is looking more or less resolved.
Switzerland refining is plausible, yet US gold flows remain intertwined with geopolitical bargaining. As Andy Schectman points out here, controlling discounted oil from Iran and Venezuela potentially creates leverage over China for rare earth negotiations, but delays in diplomacy, such as the Trump-Xi meeting postponement, amplify uncertainty. Investors miss these complex supply chain intersections, which could affect gold pricing and strategic reserve allocation. Understanding these nuanced trade-offs is crucial for macro-aware portfolio strategy. Next, Andy Schectman shows how delayed negotiations intersect with gold and mineral leverage globally.
What do you make of that theory?
Well, I mean, how's that worked out for the U.S.? I mean, there is credible information. I was listening to Luke Roman talk about it today, that ships that are with Chinese manifests, or it's even gone as far as say oil that was paid in China, or paid with yuan rather, are being allowed to go through the strait. And so oil is making it to China. That's the silly thing about all of this, and that is a theory that you had that you didn't have, that you talked to me about, that I've seen all over the place. This is being done specifically to put a hand on top, or the thumb on top of China and their oil imports. But the funny thing is, oil is getting through to China in theory, maybe not as much as it once did, but it is getting through. And look at Russia; they're having no problem selling their oil. In fact, their profits are going way up because of this. So the interesting thing about all of this is that it is showing up here in the United States, where we have Biden era high gas prices again, and inflation on the way. And so, sometimes the unintended consequences, or things don't always work out like you think, seems to be happening as it pertains to that theory.
Strategic attempts to control China's oil supply reveal the gap between intention and execution. As Andy Schectman points out here, shipments paid in yuan continue reaching China, undermining US leverage and highlighting unintended consequences for domestic inflation and fuel costs. Investors often underestimate how these geopolitical moves ripple into markets, affecting energy prices and macro sentiment. Understanding the disconnect between theory and reality is critical for risk planning,